Welcome to KBRA Podcasts, where we cover topical research discussions, industry commentary, and more. Stay tuned for insight from our knowledgeable team members.
I'm Joan Feldbaum-Vidra, and I look after sovereigns for KBRA. With me here is Ken Egan, KBRA's lead analyst on the UK and also lead analyst on many European sovereign ratings. He also works on Latin American credit for KBRA as well. We organized this podcast to discuss KBRA's recent rating action on the UK, as well as our management of the UK credit ratings since they were first assigned in 2018. In this podcast, Ken Egan will update us on the current macro situation in the country. Welcome again, and let's get started. Ken, great to have you featured on this podcast to discuss the recent rating movement of the UK. Can you review for our listeners KBRA's recent history? It demonstrates that we've been quite patient on the credit rating of the UK for some time. Is that right?
Yes, thanks, Joan. After the rating action on Friday, September 2nd, 2022, KBRA's sovereign ratings of the UK are AA and K1+. We have a stable outlook on the long-term ratings now, and this is our current rating stance on the UK. We did have a negative outlook on the UK since we assigned the rating in August of 2018, 4 years ago. Now, admittedly, that changed to watch downgrade in October of 2020 during sort of peak Brexit concern. And with no tangible trade deal in place and the clock running out, we resolved this back to negative outlook then in January of 2021 after the signature of the Trade and Cooperation Agreement, the TCA, which removed the immediate risk of a severe economic shock. It's a rating we've carefully scrutinised over the years because I think we weigh up the strong fundamentals against deteriorating underlying credit metrics. So after 4 years last week, as I mentioned, we downgraded the UK's long-term ratings to AA from AA+, and the outlook was revised to stable from negative, as that is appropriate for the new rating level. We tried to be more data-driven at KBRA and not so overreactive to headlines. I think initially we assumed, like many others, that Brexit would be softer and the resilience of the economy would ultimately stem the bleed. This analysis was based on the Brexit agreement initially agreed by Theresa May's government. But the dynamics have evolved, and Brexit in actuality, which we view as a hard Brexit, has been and continues to be a drag on several parts of the UK economy. And the future of this agreement continues to have uncertainty. For example, at the current juncture, the parliamentary bill regarding the Northern Ireland Protocol. The macro side of things have also contributed to rating pressure, which I can cover shortly, particularly inflation. But stepping back for a second, we also recognise the very strong fundamentals of this country. The UK holds a reserve currency status and has incredible financing flexibility.
Thank you, Ken. Can you also update us on the current state of affairs in the UK and why the decision to move on the rating now?
Sure. So I guess the most obvious starting point is inflation, which is now in double digits at 10.1% and forecast to rise to 13%, according to the Bank of England's official forecasts. And again, this could yet prove optimistic. There's a lot of uncertainty around forecasts, obviously, and this has been evident for a while. It's also true that most sovereigns globally are facing higher inflation and a tougher growth situation. But the UK is an outlier on these, and there are a few reasons why. Firstly, income inequality is higher in the UK, but also households are generally getting poorer. That is not a problem just for the UK, of course, and we see it elsewhere, for example, in the US, with income inequality a contributing factor. British household energy mix is more reliant on gas than others. Electrical production in the UK is more reliant on gas. Crucially, household debt is somewhat higher in the UK compared to some peers. Private consumption contributes more to GDP in the UK when compared to peers also. I'll come back to inflation in a second, but the idea is essentially that houses are already in debt. We have energy bills that are rising by 80% next month and forecast to rise by another roughly 86% again by next spring. So a massive contraction in disposable income, a fall in consumption, dragging the economy into a prolonged recession and stagnation. Further to this, mortgage rates in the UK are typically 2 to 5 year fixed, and homeowners will face higher repayments in line with policy rate increases over the next 18 months should their reset date fall within this period. So on inflation, a few reasons why the UK is different. Firstly, it's a net importer economy, so it's highly sensitive to supply lines, energy, currencies. I think overall the openness and capacity of the economy has been reduced by Brexit and shocks. such as COVID or the current energy crisis or cost of living crisis, which kickstarted by the war in Ukraine, create bigger distortions in supply and demand, and the economy responds more directly. Core goods in the UK running about 2.2% higher than the euro area average, for example. Again, note the UK is a much more flexible economy, more similar to the US than European countries in this regard. There's naturally more volatility, something we see in similar countries. Wage growth is double the pace as most advanced peers, except for the US. Inflation expectations are much higher in the UK than the US and euro area. Inflation is impacting government finances, it's impacting the cost of living, and it's impacting the currency. On the government finances side, inflation-linked government debt makes up almost a quarter of all issuance outstanding, versus about 8% for the US and France. The next highest in the advanced economies in the world is Israel. That's just below 20%. But with inflation in double digits, this means the redemption and coupon payments are much higher. For example, the UK paid 19 billion on government debt in June. The OBR forecasts that interest payments on outstanding debt will be roughly just shy of 90 billion for this financial year. This represents a meaningful rise in the cost of debt. For example, debt interest payments totaled just over 60 billion for all of 2021. Now, we should mention that the UK has incredible financing flexibility, reserve currency status, and sterling has an important role in international transactions as the fourth most traded currency in the world. So it has extremely high access to liquidity. Yes, the UK can issue in deep and liquid gilt markets and raise what it needs, but the cost of this debt and the amount of borrowing will keep rising over the medium term in relation to GDP. Brexit has and continues to impact the economy, particularly around trade and investment. And this is another key factor for us to consider. Because of Brexit, trade has not yet responded to a weaker currency. And over the long term, the OBR believe current Brexit agreement will deliver a 4% hit to GDP. This is just a forecast, of course. And we also note that it takes time to adjust. And the recent period of adjustment since Brexit occurred was encumbered by the pandemic environment. Politics and policy continues to be uncertain, which also hampers investment. There's particular uncertainty with regard to the Northern Ireland Protocol and future relations between the UK and the EU. Many of the credit metrics for this sovereign have been directly or indirectly impacted by Brexit.
Ken, that was so helpful to helping us understand about the differences in the UK and the sensitivity to inflation. Can you please discuss the rationale for the stable outlook on the long-term ratings?
Sure. So following the downgrade to AA, we moved the UK's long-term ratings to a stable outlook. The UK is a very flexible economy, similar to the US, as we noted, and innovative, which indicates it has the ability to rebound after challenging periods. For example, growth levels were quite solid in the years that following the Brexit referendum, higher than many European peers despite the relatively favourable ECB monetary policy stance. The UK has incredible financing flexibility, and the DMO have done a great job managing the UK curve.
And just to continue on that, the stable outlook indicates that you don't expect rating movement. And given the negative trends you mentioned before, why is that?
Overall, and I know I'm repeating myself, but the UK is a large and wealthy, resilient, institutionally advanced, innovative and flexible economy with high quality institutions and governance factors. It's the fifth largest economy in the world and a critical actor in geopolitical affairs. All of these factors influence its rating positioning. Another positive to note is that the status of the UK's large and globally important financial sector is expected to remain a magnet for jobs and investment, despite Brexit risks. Some of the data is still clouded by various shocks, mostly external, like the COVID pandemic, so it's hard to make very solid predictions. From this level, we would need to see significantly increased pressure on public debt levels, a meaningful deterioration in employment and immigration. Of course, a meaningful change in access to liquidity would also be a key credit sensitivity, although this is not expected. We believe the headwinds and challenges are contained for the UK at its current rating level.
Ken, thank you so much. This was so helpful. I want to thank our listeners. Please reach out to the KBRA Sovereigns Group or any of our colleagues if you have any questions. Thanks so much for joining us.
This concludes our episode. Please continue the conversation on LinkedIn and Twitter at Kroll Bond Rating. We'd also like to remind you that all of our ratings and research reports are available at kbra.com. Lastly, please share any feedback or ideas
Ken,
for
it's
future
great to have you
podcast
featured on
episodes
this
by emailing
podcast
us
to
at
discuss the recent rating
media@kbra.com.
movement of the UK.
We hope to see you next
Would you
time.
review for our listeners our rating history on the UK and how it demonstrates that we've been quite patient for some time? Thank you.